Hi, my name is Looney and I'm here to give you a different view of impact investing. One that puts the impact aside and focuses on the investing. Now, in investing, there's a simple measure of success. It's called return on investment. And in early stage seed and angel investing, that measure is 10x, 10 times your money back. But as research shows, it's not 10 times your money on every investment. It's 1 out of 10 of your investments that have at least a 10x return. So the results here are from Jeff Entrust's Super Angel. They're corroborated by Rob Wiltbank, who does research down at Willamette University on thousands of angel investments. The numbers for this come out 2.3 for Jeff's numbers, 2.6 for Rob's. Let's just call it 2.5 times your money. You're expected, if you're a successful angel, to be able to make 2.5 times your money back in 7 to 10 years. But this only works if you can get one of those investments to be a 10x. So what happens if you're investing in an area that doesn't have 10x's? What happens if you're investing in a field where there aren't any Googles or Microsofts or Facebooks or Cisco's or GE's or other companies that make acquisitions every week? What if you're investing in an impact space where entrepreneurs never sell their company? At best, they sell out their company. Well, to answer this question, you have to go back to Investing 101. And in Investing 101, you'll find just 2 forms of investment, debt and equity. Now, in early stage investing, debt doesn't work. When you hand over some money to an entrepreneur, in debt, what they're promising you back is a fixed payment over a fixed period of time. And there's 2 problems with this. 1, the entrepreneur can't afford that fixed payment at the beginning. They don't have any revenues to pay you. And 2, you can't charge a high enough interest rate to make this numbers work out, to make it 2.5 times your money back. Now in equity, you hand over some money up front, and then you wait around for someone to buy the company, then pay you back more money than you gave them. Well, if there aren't any acquisitions happening, well, this can't happen. And so you're just parking your money and you're getting no return at all. So 2 years ago when I started Fledge, I thought this was an impasse. I thought there wasn't any way around this. But then I found a third choice that was being used in Seattle for growth capital. And so I brought it back for seed capital. It goes like this. It's called revenue-based financing. In a revenue-based financing, you hand over money to the entrepreneur, just like before, and in return, they promise you a fixed percentage of their top-line revenues, and not for a specific amount of time. They're paying you back a promised return on investment, usually a multiple of that return. And in seed stage, the norms for this is 3 to 5x return. So when we look at this compared to debt and revenue, it falls right in between. It's something like debt. You're getting a payment over time, but it's a variable amount. It's an amount that the entrepreneurs can handle. And like equity, you're taking a risk that it might be higher than you expect. If you get paid back sooner, you're getting a higher IRR. And you're getting paid back over time, which means if you plug that in to the IRR calculation, you'll find that you might get 5 or 6 or 7% higher IRR than in an equity investment. Let's put these numbers back into the same form we saw before. And let's assume we are no better at picking stocks in this form of investing than we were in equity. So if less than half, if 4 out of 10 of the companies pay us back the full amount, and 3 out of 10 pay us less than half of that, and 2 out of 10 just return capital, and 1 is a total 0. And in this case, a total 0 is a total 0. This is a company that has never earned a dime of revenue. That's a really bad investment. Well, the weighted average of those come out to be, in fact, higher than the other form of investing. And so maybe we're being a little generous. Maybe only 3 out of 10 pay us back the full amount, which is pretty bad, right? 3 out of 10 are winners. Well, in that case, we're still making the ballpark of 2.5 times money. But the difference is that you're being paid back over these 7 to 10 years a little bit at a time instead of waiting around until the end to get a lump sum. Now, this is not a theory. This is the form of investing that I use at Fledge, the Conscious Company Accelerator. We've done 25 of these. The entrepreneurs absolutely love it. They love it so much that they're doing their follow-on investing in the same form. And what's really exciting is that when you use this model in impact investing, you have the market rate fiscal return, but then you have all the upside in the impact return. So if you want to learn any more about revenue-based financing, or you want to talk about this online, then come to my blog at lunarobiscuit.com. Thank you.